What is up, friends? Welcome to the Ronnie V Show. We are live. We are going to be talking today about fundamentals. We're going to be talking about a ton of different stocks like Zeta and Oscar, and we're going to be talking about these markets and how they're up. Hope you guys are all doing very, very well today. It's been a little bit, so let's get right into it. These markets are insane. They're insane. They're crashing, they're pumping, they're crashing, they're pumping all over the place. All over the place, friends. It is absolutely crazy out here. Let me get this posted on over to X so we can have our friends over there as well. Come on over into the stream. Post this. Let's see. It's been absolutely a crazy week with the war and everything going on. It's crazy. It is crazy, guys. But lots of great deals out there. A lot of great deals, opportunities right now. Lots of great deals, guys. Lots of great deals. Zeta, Oscar, Hood, SoFi, Envis, Iran. All right, we got that on there. We're live on X now. Love to see it. Oh, wait, were we already live? Did X fix that bug? Yes, looks like they fixed the bug. Okay, I'll just delete this one. Okay. Okay. What have you guys been up to? How's everybody doing? What stock should we talk about? Drop a comment where you're watching from and what stock you want to look at on Value Snapshot. Let me know. Let me know. Let's get this shared up here. Love the Zeta interview, Ronnie. Congrats on landing that. I appreciate it, man. Glad you enjoyed it. I enjoyed it thoroughly. I enjoyed it thoroughly, for sure. Talking to Chris Greiner was awesome, and getting like a glimpse into, a CFO's role and what he's working on. That's such a great company. We are up today 2.25%. Holding well above $18 now, so amazing. But let's talk about Zeta, huh? Zoom in here. Let's talk about Zeta. What do we want to talk about Zeta? Let's talk about recent earnings, right? Let's see. I'm over here on valuesnapshot.io, by the way, guys. You can come on over here. We have access to discovery, data, direction. These are our 3Ds. This is my 3D framework for how I invest, discovering a stock, and then looking into the data, the financials, and the valuations, and then getting in first half position based on fundamentals and oversold, getting in second half of the of my position based on the direction. We have value analyzer, financial tools, AI reports, community, chat, portfolio, feed, articles, all right here, investment feed, my whole portfolio, everything I'm buying right now. We got chats. All my articles are in here that I've been posting, and Zeta is the article I just posted not too long ago, talking about those amazing earnings. But let's look at the overall markets right now. Overall markets are up today. Update the data because I want to see who is leading. So, energy and utilities, industrials and materials are all still leading the charge in 2026 for this past month so far. So, these are all still up and away. While software, AI, machine learning, cybersecurity, fintech, all these are down in the dumps. And I really like a lot of these companies. I really like Zscaler. I really like Now, Snowflake, Oracle, Microsoft. Obviously, that's an easy buy. Buy and sleep well at night stock. Net and 40net. All these companies are really, really good. As far as financial companies, if they have them on here, probably not. Fintech, I need to do a fintech one in here instead of just financials because yeah, financials are down. I do like you can't go wrong with my Mastercard or Visa here. Mastercard or Visa is I think it's an easy compound. Both of them are easy compounding machines, and I think they're undervalued where they're at right now. Wouldn't touch PayPal with your money. AXP, American Express, another great one. But honestly, Visa and Mastercard are basically just as undervalued as American Express, so I'd rather go with Visa or Mastercard. All right. Um, let's talk about Zeta. Let's talk about Zeta. Zeta is on a tear. Zeta is on a tear. They are at $18.46 today. They crushed their earnings, guys. I mean, let's take a look at this. Let's take a look at these quarterly earnings. This is their net margins every single quarter dating back since 2023. We can actually scope this out some more. Let's get some more data in here. Let's go out to 2023, right? So let's just look at one at a time. So gross margins have been 58% and then they petered out and they just been staying stagnant. In this past quarter, they've skyrocketed to almost 73%, guys. And then you want to talk about operating margins. Well, operating margins have gone from negative 33% all the way up to hovering around this 2 to 4% area the last few quarters, and they're starting to get sustained positive operating margins. Then you want to go over to net margins. Net margins have gone from negative 36% all the way up to 1.7%, with obviously a positive net income quarter for this past quarter they just reported. And then free cash flows, the lifeblood of the business, guys. These have been up and away 6.4%, all the way up to 15.5%, we'll call it. Absolutely massive, guys. Massive for this company. And Wall Street's still so late on this company, guys. Look at this revenue on a quarterly basis. 158 million to 395 million per quarter. Over doubling what they're doing per quarter in just a few years. And then like we see the $7 million, 280% increase of net income. I mean, what more do you want to say about this company? Gross and operating profits are up and to the right. EBITDA is absolutely flipping. The last 3 quarters, 6 million to 15 million to 21 million. They're crushing it, climbing higher on EBITDA. Look at this free cash flow on a quarterly basis. 10 million all the way up to 61 million, a 6x in just a few years. Look at the CapEx and dividends. CapEx is coming down. They're not spending a ton of money. They don't need to spend a ton of money, even though they just made an amazing acquisition. I found you on Blossom. I also like Zeta, Path, Nebius for 2026. Like update info, and you seem very knowledgeable. Thanks for your hard work. I appreciate that, Jeff. I appreciate that. Just trying to help people out, you know? And help people out, but like honestly, like to be a bit selfish, Like, I love this. I love trading. I love investing. I love talking about stocks. So to be selfish, this is my passion. I love to get to do this, and helping out other people and having an audience to talk to, like, that makes it 10 times better. So win-win. Balance sheet overview, $1.5 billion in data. Total liabilities is 698 million. So they have over double total assets versus liabilities. And their cash to debt, cash as of this recent quarter, 320 million they've made versus 197 million in debt. Shares outstanding have actually been staying in line. So people were complaining about them going up and away from 150 all the way up to like 213. And then since then, they've teetered them out. 213 to, basically staying in line here. 222 million, 222 million, 217, 222, 213 to 222. They're leveling them out. You see this? They're leveling them out, and they're actually buying back shares right now. So yeah, but it's also a growth company, and they guided for 35% revenue growth this year. Massive. Here's that 0.03 cents of EPS this quarter. They're guiding for 2 to 4 cents, and the CFO Chris Greiner, on my interview with him, he actually said that's very, very conservative. And it obviously depends on their share price as well. So yeah. Let's see. Debt to equity ratio, amazing. Free cash flow per share, explosive. Return on assets, really getting there. Love seeing this, just climbing higher, flirting with positive, and now really flipping to positive fully. Return on equity, flipping positive. Price to book, a measly 5.63. So, yeah, guys. And what's their price to sales right now? Let's run some valuations. Pull up Zeta. Again, guys, if you're just joining, if you want to follow along with me, or if you want free access to Value Snapshot, you can get free access. Just come over to valuesnapshot.io. You get completely free access. You can run up to 5 valuations. You can look at 5 different stocks and their financials. You could do all that for free without any kind of credit card. And then you can actually have a 7-day free trial to use the system as well, and have access to the community, see everything I'm doing also. So if you want access to that, just valuesnapshot.io. And yeah, it's completely free for 7 days. And if you forget to cancel, it's literally $8 a month. So you're not getting, just taken to the cleaners. It's literally less than a quarter a day. So if you want access to what I personally use to help me find and analyze any kind of company for investment purposes, you can come on over to Value Snapshot. But going over to the value analyzer, let's run some projections. A measly 3.5 price to sales ratio. A measly 3.5 price to sales ratio. If you don't know what this is, imagine you're buying a piece of a lemonade stand. The price to sales ratio tells you how much you're paying for every dollar of lemonade that stand sells. A lower number means you're getting more sales for your money. Nice little quick, easy description for you here as well. So 3.5 price to sales. I think they should be trading north of 6 minimum. And if we look at what analysts are guiding here, analysts have price target on the low end of $25, 35% upside here. Consensus of 29, 56% upside, and a high of 36. These are Wall Street analysts, guys. These aren't me. This is Wall Street analysts saying, yeah, our bear case is 35% upside at $25. And we're currently sitting at, let me update my thing, $18.42. So yeah, it looks really good. There's a visualization for you. You guys got questions, drop them in the chat. If you want me to look at any particular stocks, drop them in the chat. Let me know. Make sure you guys are liking the video, sharing, subscribing, doing all that great jazz to help me out. I appreciate you. All right, so where are we at? I just did this one, right? So for a 3-year projection, this is a DCF model, discounted cash flow model. For a 3-year projection, 1.3 billion is what they're currently doing on a trailing 12-month basis. They're guiding for 35% revenues this year. Let's just say it's a one and done year of over 30% revenue growth. Then let's just say over the next 3 years, 3 years total, on average, are only going to grow 21%. That would mean like they would go down to 10 to 15% revenue growth for like the next 2 years. Again, I don't see that. But let's just say only 21%. Then let's say they're currently doing 15.4% free cash flow margins. Let's just keep it at 15%. And then they're currently trading at 25 when they're very undervalued now. So let's keep it at 25 at the end of 3 years. And you see it right there. Very conservative assumptions. Very conservative assumptions. I would call this honestly, I would call this like the bear to base case on Zeta for me. The bear to base case on Zeta. I think it's a great opportunity right now. Can it go lower? Of course it can go lower. We don't know what's happening with the whole Iran conflict. We don't know what's up with all that, guys. Like, of course any stock can go lower. Like, let's not be crazy here. But based on DCF, it's undervalued. Based on price of sales, it's undervalued. Based on PEG ratio, based on rule of 40, we can run all of those here if we wanted to. We can run all 4 of those metrics here all at once if we wanted to. And we'll see that it's undervalued, guys. Revenue growth of 35%. They got profit margins clearing like 4% now. So they have a rule of 40 of 40 right now. PEG ratio, they're growing EPS like crazy, even more than that. You'd filter this all the way, honestly, like 200 and some percent, because they're flipping to profitability. So, it tells us it's a strong buy. Oh, hold on, sorry, gotta fix this. So we would look at a 30 times multiple. Yeah, you can't fix this because let's go. We gotta go over here, because this is showing negative EPS, obviously. But they're going to be at, let's say, 4 cents this year. Let's go out 5 years. Let's say they grow at about 65%. Actually, from 4 cents to 49, I think they would grow like 100. Say 100%. 100%, getting to $1.28, 5 years time. 30 PE, yeah, that's what they'd be looking at. But obviously going from 4 cents, I think they're going to jump bigger in the earlier times and then level off with their growth. So like you would probably see like 300% in the beginning and then leveling down to like 100%, 50%, so on and so forth. But anyways, yeah, looking at all 4, yeah. AI synthesis, strong buy, DCF, EPS, healthy rule of 40, great PEG ratio. Looking at all of it, guys, it's a great deal. It's not financial advice. I'm just running some projections based on my assumptions. If we were to look at, so crazy thing, let me pull it up over here. I'm gonna go over to my X account. Let's see. So my good buddy, Wealthmatica, he put together this thread on Zeta and was talking about Zeta Global just concluded their feature on Morgan Stanley Technology Conference. And basically his interview with the CEO, David Steinberg, my interview with the CFO, we're seeing that Zeta could actually grow to get to $10 billion in revenue by 2030. And so because they can get to $10 billion in revenue by 2030, you could see a company 7 to 10x in the next, like 4 years, which is absolutely crazy. But all they would have to do, they're currently at 1.6% wallet share. They would only have to get to 6.2% wallet share. And they wouldn't have to bring on any new customers, any new clients. This is only if they were to grow their current clients. So here's like a visualization of that. 1.3% of wallet share up to 6.21% of wallet share by 2030 would get them to about $10 billion in revenue. Guys, if they got to $10 billion in revenue, nobody's ready for that. Guys, nobody's ready for that. Look at Wall Street. You want to look at Wall Street analysts' projections? We'll look at LifeMD and those in a minute. And we'll look at Netflix too, friend. So look at this revenue. By 2029, 2.58 billion. These four analysts here and one analyst here are only expecting them to grow sub 15%, which is crazy because management is sitting there telling us they expect to grow 20% CAGR, compounding annual growth rate, for the foreseeable future. So they're expecting to grow 20% every single year for the foreseeable future, and they've already been doing this year in and year out. But these analysts that don't really know much, clearly, but are bullish because they have $25 low, 29 and 36 as their price targets, they're not ready. 2.58 billion? Guys, in 2029, they could be doing 7 billion. Over 3 times more than what analysts expect on the high. Do you understand how crazy that is? What's up, friend? From Barcelona, that's amazing. What's up? This is insane. So $10 billion by 2030, that's ultra bull case. That's ultra bull case, guys. And if we ran projections on that, right? Yes, it's $200 billion. Thank you, Siri. If we ran projections on that like I did yesterday, let's play a game. Zeta hypothetical. Also, if you want to follow me on X at the Ronnie V Show right here, you could do so. Let's play a game. Zeta hypothetical gets to 10 billion revenue by 2030. That's a 66% revenue growth rate per year over the next 4 to 5 years. Free cash flow margins of 16%. They're currently doing 15.4%. So that's saying that the free cash flow margins actually stay small, which I think those continue to grow. Same with net margins. Terminal multiple around 30, which is actually very cheap. If they're growing over 60% per year, this would return around 700% from today's price. Here's a little breakdown, and we can pull this up on Value Snapshot so we get a better look at it. So guys, yeah, let's do 5 years. You know what? I'm going to do 4 years out to 2030. And like I said, 66%, only getting to 16%. You see here, that's $9.9 billion in revenue by that 4th year, by 2030, and giving us a 30 terminal. You see that the stock price intrinsic value today would be $142. The 4-year target would be $193. Again, this is a $18.52 stock. So we are talking about over a 10x for this 4-year target if they were to get to 10 billion in revenue and not even increase their free cash flow margins. What's up, Wealth? Look, well, I'm going over Zeta projections for 10 billion by 2030. So guys, look, 4 years out, they're at $1.3 billion in revenue. If they grow at 66% revenue growth and get to 10 billion or 9.9 billion by 2030, they would have 1.6 billion in free cash flow. That's not even if they grow their free cash flow. I think if that's the case, they could get to at least 20% free cash flow margins. And honestly, 30% terminal at the end of 4 years, even though they just grew 66% per year, they're completely taking over the MarTech markets and just gobbling up total addressable markets, and their wallet share is increasing like crazy to 6%. And they talk about wanting to get it to 10%. So when Wealth ran those numbers that we were just looking at here, when Wealth ran those numbers, he wasn't even talking about 10%. He's talking about 6.2%. And that's what the CEO just said. The CEO was just saying in his interview, David Steinberg, that he wants to get it to Where's it at? Let's see. David indicates a version of 2 Athena, blah, blah, blah. Yeah, I don't know. I don't know where it's at. I don't know where you got it at, Wealth. Oh, yeah, like right here. By the way, all I need to do to get there is grow my current clients. I don't need to expand my current audience. So remember he said 75% of EBITDA will translate to free cash flow. Yeah, it'd be insane, dude. It'd be insane. So still not going too crazy here. But guys, if they're growing at 66% CAGR, what are we even talking about? They would have a free cash flow terminal of like, honestly, probably up above 70. But let's just say 50, which is still conservative. They're growing 66% revenue growth. Look at Palantir. Let's look at Palantir. This is you want to talk about something? Palantir's growing at like 60 some percent. Palantir just grew like 70 some percent earnings, right? They have a free cash flow terminal of 166. But we'll just say 50. 50. Oh my God, $287, $402 at the end of 4 years. It's insane. You want to talk about the next Palantir parabolic move? It could be Zeta, guys. And we've been talking about it. Look at this. Look at this. Let's go back to conservative land. 16%, 66%. Let's just not even say they get to 10 billion. Let's say they only grow 40% per year for the next 5 years and they only get to 5 billion. What? Still $73 stock. Still 300% upside from here. Getting to about $100. In 4 years. That's insane. Compared to AppLovin, people cry if you compare to Palantir. Well, I just meant like the parabolic move of Palantir. But if you want to look at AppLovin too, if you want to look how crazy they're growing, they've been growing their revenue by about 25 to 35%, and they command a 40 free cash flow multiple. And that's after the big sell-off. They were well above 60 on the free cash flow multiple as well. So, wow. You just run these numbers in here. Let's just say 40%. Let's just say they only get to 5 billion. Again, you're looking around at 30 times, $73. If you go up to 45%, you're looking at 83 up to 100. Down here, if you have a higher free cash flow multiple, you're looking at 114. Like, what are we talking about here, guys? Year to date, we're down. We started off with a bang with the OpenAI partnership, ran up to $24.40, which was very still undervalued in my opinion. I believe this is a $37, $40+ stock, but whatever, right? We got to start somewhere. $24 all the way down to $15. We actually were sub 14, I think. Yeah, we're in the 14s. That was very, very low. But guys, you just look at this thing and oh my gosh, like it can absolutely go parabolic. It could be one of the craziest rides we've ever seen. I mean, and we could look at Palantir right down here in the 5s and 10s, and it ran all the way up to 210. So for Zeta, right, a company that really hasn't been in the 5s and 10s, we'd be looking at 15 to 20 range, running all the way up to $100 to $200, which is insane. It's insane. It's insane. It's insane, guys. Just so you guys know, I'm putting my money where my mouth is. I'm so bullish. Zeta has become my number one stock. I'm more bullish on Zeta than Oscar. Oscar's still number 2. It's nothing against Oscar. I just don't like the whole like political landscape with that. and how it affects them so much. But make no mistake, I'm still very, very bullish on Oscar. I haven't sold anything. I'm still in it. Like I'm still holding my leaps. I'm still bullish as ever. I still think they're going to crush it as well. But the opportunity for Zeta is just so much greater. It's so much greater. So again, don't take that as like I hate Oscar and I love Zeta. Like I love both of the companies. They're both great companies. But I'm finally going to say it. Zeta is number one. Zeta is number one for me. It can't not be my number one, guys. It's too good. It's too good. What's up, MPS? Love Zeta. Heck yeah, man. It's so undervalued. Yesterday, the market was like the the small caps where Zeta lies was 3.6% down, and Zeta was up 1% at one point. That is strength. That is strength, guys. That is strength. Let's talk about LifeMD. LifeMD. There we go. LifeMD. 0.6 price to sales, market cap of 149 million, super small company, $252 million in revenue. They must not be pulling in net income. Yep, negative 4.6 billion in net income. They don't have free cash flow, so I already am like, it's already tough for me. Analysts have, way higher price targets on this of 6, 8, and 10. But how many analysts are there covering this thing? Again, they're negative free cash flow. So my thing is like, if I can't value it off DCF and I can't value it off EPS, how do I value it? What's their rule of 40? Growing revenues 32%. Let's say 39%. Still negative net margins. Let's do minus 2.5. It's still under rule of 40. You really have to understand LifeMD. You really have to understand the company for you to comfortably sit here and like want to buy. You can't just buy off peg. Let's look at the financials. Let's look at trailing 12 month. Let's look at yearly actually, because the year just ended. 79. Oh, their gross margins are growing. That's good. They had great net margins, free cash on margins. Or no, sorry. Hold on. Hold up. Negative 5.1 net margins to negative 8.9. So over almost a decade, guys, their net margins have gone nowhere. Yet their revenue is just skyrocketed. They went from 1 million in revenue to 212 million, and they haven't grown net margins. So they're just selling to sell. They're selling to sell, and they're not making any money from it. Operating margins from negative 21% to negative 7%. That's better. And then free cash flow margins from negative 24%. They are climbing here, and they printed their highest free cash flow margins ever here at 2.4%, 2020. Let's look at trailing 12 month. What's up, Trevor? How's it going, man? You just missed Zeta. We were just talking about a ton of Zeta, everything, financials, value, everything. Scroll back if you want to watch that. 0.01. Their free cash was just very choppy. 4 to 5 to 5 to 4 to back and forth, back and forth. Net margins are growing. Okay. They are growing. They do look a lot better on trailing 12 month. Same thing with operating margins. Revenue's growing. They're getting close to flipping to profitability here on the revenue and net income. Gross and operating looking good and actually flipping on operating income there on a trailing 12-month basis. EBITDA is getting there. Cash flow is decent. How about the cash to debt? Not bad. Okay. 24 million in cash, 0 debt. Okay. Shares outstanding climbing. Almost 10 million more shares. EPS climbing, trying to get close to EPS positive. All right. What was their free cash flow margin again? It was 3.7. So 4%. So let's go back to DCF model. And let's say they grow at 30% per year and they have a 4% free cash flow margin. Let's give them a 25 terminal multiple. All right. So, well, they're medical, so let's leave it at 20. Let's get in the benchmark 15 actually. And that's our historical, but that's showing different. Let's give them a 2. 2% revenue growth of 25. See what analysts have to say. 11 to negative to 17 to negative 11. Ugh, okay. Yeah. So, I mean, analysts don't really see this company growing. So, can't really be doing 30%. Do 8% at 2, it's overvalued. They got the 15% at 3. You see, it's just kind of like, where do we go here? Right? You really got to understand this business. Because if and their free cash flow margins are up, down, up, down, up, down, I don't like that. So I can't pinpoint this. And they're negative net income. They're negative EPS. So again, I don't understand the business. I don't know it. LifeMD. LFMD. There we go. Let's go with detailed. I gotta zoom back out of this. I'm all messed up. I highly recommend you ban that Trevor guy from the chat. He's a wannabe Jeremy stock trader. Lol. You guys are boys. Don't BS me. Pharmaceuticals industry with a significant growth trajectory, but also considerable financial volatility. Business overview operates in the telehealth sector, providing virtual healthcare. A lot of T-Doc. There's a lot of virtual healthcare companies, services, and pharmaceutical solutions. The company's business model focuses on connecting patients with healthcare professionals through its digital platform, aiming to make healthcare more accessible and convenient. I'll just be honest, I cannot invest in a digital virtual healthcare provider company. It's too disruptible. Just look at T-Doc. Teladoc was all the rage, guys. Let's see. Let me pull this up. I want to really show you all the rage of Teladoc. I just can't invest in a company like this. Look at T-Doc. Okay, T-Doc's at $5 today. Woohoo! Okay, check this out. This was, let's go 10 years. This was right here, 2021. January 2021. This is when things were very euphoric, all this different stuff. LFMD institutions were selling last 3 months. Yeah, don't like that either. So, oh my gosh, COVID, telehealth, it's the future. Let's bid this thing from freaking $16 all the way up to $264 and then crash down 58%, down 82% all time from the highs here. Like, yeah, yeah. I'm good. I'm good. They're too disruptible. And since that time, Teladoc still isn't a positive net income company. Look at their revenues. Look at those revenues right here. Look at these. 2 billion in 2021, 2.5 billion in 2025. And they lost 200 million less. Whoa, good job. You get a cookie. No. Pass. Guys, look at these gems today. All right. Dang. Zeta, 3% up. Oscar Health. Mwah! Let's go, baby. 7%. 7%. Mobileye, 1%. 1% up. This one's gotten beaten down too. But I think in 2027, this one's gonna have a turnaround with robotics and with their robo taxis and everything. UiPath, this one's been beaten down year to date. 32% from its highs, 18 down to 10, sub 10, and now is rebounding to 11. Oscar equals low margin. Well, yeah, it's health insurance. Pagayo. But yeah, Oscar's low margin, but they don't need that much margin because they just guided for 18 to 19 billion dollars in revenue this year. 18 to 19 billion dollars in revenue this year. CEO is talking about them getting to 5% margins. If they do that, this company is like stupid. It already is stupid undervalued, but 5% net margins on that, this company is like 50, 60 plus dollar company. Pagaya's just been beaten down. My goodness. I'm like down like 50% of my position. It's insane. $45 and I was buying at like 20s to 30s. UNH is better than Oscar. Well, obviously, come on, Nick. Oscar is a $3.8 billion market cap. UNH is a like 200 and some billion dollar market cap, $266 billion market cap. I would hope that they were better wealth. I would hope that they had way more clients, way more money, way more free cash flow, all of it. Yes. Oscar is a disruptor. It's the same thing as Zeta. Not the same thing, but it's a different thing. Meaning, yeah, he's a D1 hater. He's such a D1 hater, bro. Zeta is going after disrupting Salesforce, Adobe, Oracle. Those companies are all hundreds of billions of dollars of market cap. UNH is hundreds of billions of dollars of market cap. Zeta, Oscar, around $5 or less billion market cap. They're going to disrupt. You're down $60,000 on Pagaya. Sorry, friend. Unrealized though. It's all unrealized. Pagayo, I still think it's undervalued. Let's look at PGY. It's financials. What really sucked for them is fintech has gotten smashed this last few months. On top of that, they came out and they gave conservative guidance. If you can see past the conservative guidance and understand that they were being very conservative when they gave that guidance, and they'll probably do better than that, then it'll do you good if you can look past that. If you can't, then it's going to be tough to hold. But I do believe, in my opinion, the worst of the sell-off for finance companies, SaaS companies, healthcare companies, and cybersecurity companies is behind us. I do believe that. I do believe the worst of the sell-off is behind us. Looking at tech software today, up 2%, it's down 20% in the last 2 months, 117 all the way down here. And I even made a post on X. You see this? So 80s, 80s, 80s. It bounces off this 80s, and then you go back to here, 80s. 2021 high. So resistance, support, 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 support. So far, support. Very strong support resistance line here at 80 to 90. So I believe the worst is behind us there. Pagaya, trailing 12-month. See their yearly. Can we get 2025 here? Yes, we got it. So looking at the gross margins, or just looking at the quick insights, $1.3 billion market cap. They were just sub 1 billion, so they bounced pretty nicely since then. $81 million in net income, 120% year over year. That's great. 419% year over year increase on their free cash flow. Gross margins are up 18%. Operating margins are up 28%. Net margins are up 22% versus the start. EPS up 118%. Free cash flow margins of 17.8%. ROE of 17%. Debt to equity of 1.85. We'd like that to be a little bit less. Net cash is negative 600 million. This is because they deal a lot with loans. So let's look at the company. Look at the margins. The margins have gone. You can look at this up and down, or you can look at this 22.6% all the way up to 41%. So they're growing overall. They hit a peak. I'd like them to get back to 2022 and 2021 levels, but it's difficult, right? They are up the last few years and they are up since 2019. Hi, Ronnie, please, can you check FIG? I bought this week because a big insider purchase. Yeah, we'll check that one next, buddy. Negative 10% to 17.7% on operating margins. Again, we're not getting to those 2020 highs, but we're climbing towards them. Net margins, negative 15% to 6.5%. Again, not to the 20. If you just take out the 2020 highs, this company is doing very, very well since 2019, since 2021, since 2020, since 2024, 2023, so on and so forth. And then free cash flow margins are doing very, very well. Lifeblood of a business, negative 24% all the way up to 18%. Very, very good. Look at these revenues and net income. 36 million to 1.3 billion, and they are positive on net income. Very nice. Very nice. Does this look like a company that should be down like what? 80%? Let's see. Yeah, 70% down in the last 6 months. Again, I'm down today probably like in total like 39, 40%. I keep nibbling on this. It's all because that guidance. But look at these revenues. Look at that net income. 81 million, 1.3 billion in revenue. Gross margins higher. EBITDA 82 million. Amazing. Cash flow exploding from where they've been. CapEx is down. Operating expenses R&D is down. Look at this, 1.5 billion in total assets, about 1 billion in total liabilities. So they are a clear $500 million over. This is where it doesn't look so great. Debt keeps going and cash is meh. Mega moat in the making. Yeah, I really like Pagaya. There's another company, like it's dirt cheap right now. It's dirt cheap because finance companies were just to the slaughterhouse. Then they guided poorly. They guided conservatively, and people didn't like that. But like you look at the financials, they all look really, really good. And you look at the valuation also looks really, really good. Shares outstanding, my God, they're exploding though. That is not a sight you want to see, obviously. 16 million to 78 million in shares. They need to get that a little bit under control. I don't want to see 16 million to 78 million and 78 million to like 100 and some million. Definitely don't want to see that. EPS flipping positive, book share value down. Look at free cash flow per share. Free cash flow per share, $2.87. Looks very, very good. Looks very, very good. I do have to add that free cash flow per share, stock-based compensation adjusted to this as well. We'll get that in here as well on the site. But $2.87. Do you know what it is off the top of your head, Trevor? Adjusted here, it'd still probably be positive. Looks interesting. We'll definitely look into it. Heck yeah, MPS. It's a small cap company, so definitely speculative. But to me, it looks really good on the financials, and their business model looks really good as well. To give you kind of like a quick analysis. Dang. Oster's almost up 8%. Let's go. 94 cents, I believe. Yeah, still really solid. But again, you see what I mean. Like, you definitely want to reel that in a bit. Let's see. Pagaya operates in the technology sector, specifically software. So it's funny. They're in the finance and software sectors, and those two sectors have been completely just beaten over the head with an axe. Infrastructure, the company leverages its proprietary artificial intelligence, AI, and machine learning technology to power a credit analysis and decision network. Its platforms connects financial institutions and their customers, enabling more informed and inclusive lending decisions. Pagaya's revenue streams are primarily driven by fees derived from facilitated transactions, creating a capital-light business model with network effects. Because they don't actually do the loans, they're not giving out loans, they're not doing any of that. They're running the back end to decide who can and can't get loans and just collecting fees off that, all using AI. The competitive mode is built on its advanced AI algorithms and extensive data network, and they're partnered with a ton of loan companies, banks, so on and so forth. So first thing, people are going to be like, is there really a moat there? Nick, if he's still on here, he would say there is a moat there. I think I'd like to see them continue to grow those margins, and I'd like to see them continue to see adoption from banks and everything to really see the moat play out. But yeah, bull case, bear case, all of it's in here. Now we can look at the valuation. Let's check out the valuation. The increase in debt was actually a strategic move to issue a 500 million high yield note at lower yield. That's right, they did do that. They did issue that note, which was another ding to the stock. Yeah, they just had that avalanche of things happen to them that obviously dragged the stock down to the gutter. All right. Sub $1 billion market cap. Analyst price targets are insane. I don't know if they really adjusted, but remember, this company was just at its highs. They were just $44. I originally was buying this company back in 2025 around 30s, and I rode it up to 40 some, but then I started to see some topping patterns and started to see, my momentum indicators kind of alarming me. And I actually exited, I think at like 38 or something like that. And then I watched it fall and fall and fall. But then I was like, dang, it's very cheap down here in the 20s. So then I started buying. And then obviously I got rugged all the way down to 11 or something. But you'll see when I run these valuation metrics, 25, 31, 35, those are probably adjusted now to where they were. But you'll see as I run these valuation models, they're expected to grow 20% plus for the next 5 years. Free cash flow margins are about 18% over the next 5 years. Terminal of 5. like I said, this company's in the gutter. We should at least give it a 10. And you just see, my freaking goodness, guys. So when I was running this and I saw this company at 20 some dollars, I was like, I'm getting a steal deal. And then a bunch of things happen with their guidance, finance stocks getting cratered, fintech getting cratered, SaaS getting cratered, AI machine learning getting cratered, Claude's going to replace everything. And then all the way down to like sub 10. But you can see, like, based off conservative, I mean, just say they grow 10% and they go down to 15% margins, they regress and they keep a 5 terminal. It still should be double from where it is today, double on a free cash flow model. We look at EPS. EPS currently doing $1.01. Let's say they grow. Okay, let's pull this up. PGY. Oh, I hate Seeking Alpha because they show non-GAAP. I hate non-GAAP. So yeah, analysts have them growing about 13%, 12 to 14% per year. So again, going back to the DCF here, growing at 10% is very conservative with 15% margins, and they're currently doing 18%. So I'm going to put it back to 18%, and you're just very undervalued, very undervalued. I think I need to buy more of this company, to be totally honest. Like, this is insane. This is insane. Yeah, this is where the price is at, $11.69. And up here, $28 is where the fair value is. CFO recently said that he's pretty certain they're going to hit the mid-range of their net income guide, which puts the MAT about 50% year-over-year growth. They also began repurchasing bonds with higher yields to reduce cost of capital. Love it. Looking at EPS. Let me see. Net margin 6.5%. $0.99. So yeah, on a trailing 12-month basis, they're at about 101. Analysts expect them to grow at right around 15%. We'll be conservative and say 15% is good. That's, again, current PE is 12, and they're way off their highs. So for a tech company, I'd at least give them a 15. And holy moly, guys, that 62% undervalued for Pagaya. Crazy. Crazy, crazy, crazy. If you give them a 21 PE, they're at $26. And again, this is being conservative, very conservative. And what if they grew 20% EPS? Then you have a double from here. I wish I would have started buying now. I got $13.50. I want to buy more at $11.35. Yeah, you had a really good cost basis, man. Way better than mine, Clayton. That's because you joined. That's because you joined the community late, and then you saw what I was buying, but it was way higher. Yeah, I'm down 49%. Yeah, 20. My cost basis is $23. I'm down 49%. Yep. And I already have basically a 10K position built out in this. And a 10K position for me for this portfolio is kind of like the max I wanted to go. But it's so cheap. I might add some to bring my cost basis down, if I had another 400, I have 400 shares. If I had another 4, that'd be like 4,600 bucks. I think it makes sense for me to bring my cost basis down, honestly. Yeah, I'm most likely gonna bring my cost base down. I'm sorry, bud. It's okay, Clayton. I'm just joking. Pagaya agreed. Daily and weekly chart look great. Did you buy shares or leaps? I'm buying shares. The only leaps I hold right now, to be totally honest, are Adobe because it was just crazy undervalued. I'm down on those. Zeta, I'm break even or up on those now. Down on some actually still. Oscar, my leaps I'm down on. Mobileye, my leaps I'm down on, but they're all for 2028. So I'm just holding for the long term. Um, and look to exercise those. And I do believe all those stocks will be way higher than my break even prices on my leaps. I'm weird about, yeah, Adobe's all SaaS is turning around right now. Don't copy me. I thought some this morning. You bought some this morning, Ronnie. Follows wealth. Um, Look, when you're down 49% on a stock and then you run through the analysis, it's kind of hard not to be like, yeah, I should probably be buying more of this because it's cheap. Adobe's turning around. Yep. As long as you believe in the company long term, it's all good. I've also been down more than 50% before. Yeah, 100% MPS, 100%. You couldn't have said it any better, buddy. Let's look at these charts. I gotta make a post real quick though. I'm a troll. Okay. Let's see. Weekly chart here. That's SoFi. Pagayo. Just look where Pagayo's at, guys. Get all those wicks in there. This is absolute bottom. 725. Support, 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 support. Looking like support. And that's also in the sweet spot here. Was in the sweet spot here and came up and out of it. Was in the sweet spot here, came up and out of it, but then rejected back down. Sweet spot here ran up. This is just a downtrend here. Sweet spot here ran up. Bull trigger, bull trigger, bull trigger, bull trigger. So I'm building. If I was building a new position in this, I would be building half a position right now because the RSI is oversold. We're in the sweet spot. We're down here on the Williams percentage range. We're very, very oversold. I'd be building half position now, and then as soon as we get the bull trigger, I would buy my second half of my position. But 50 shares of Pagayo, I hold some bags also. Yep. Pagayo, there is a climax volume 2 weeks ahead. 2 weeks ago. Let me see. Yep, right there. It's huge volume. And then it's petered out. And that was whenever all like that's whenever all the bad news was really hitting. So after earnings and everything. Another one I really like is FLNC. I think they're undervalued. They're just not quite there they're not oversold yet, and they're not quite yet in the sweet spot. I do think they can come down a little bit more, maybe to like this 10 to $13 range. Ronnie, it's basically Christmas Oscar soaring. Yes, it is, friend. Yes, it is. AC, what's the news, if any? What you got? What's the news? Yes, FLNC. Yeah, I really like FLNC. The crazy thing about FLNC, guys, we rode this thing, not even from the bull trigger, because this wasn't even on my radar, but I could have rode this from 4 to 32. No news. Love it. 4 to 32. But instead, I got in around like 10 and I rode it all the way up to 32. And you can ask people in my community, my investing community on Value Snapshot. We've completely moved over there now. Guys, I sold it up at the 30s. I sold it up in the 30s because it was fair value. I saw things petering out, this double wick top. I was like, yeah, markets are, I don't know. Another one we rode onto from down here, the bull trigger, $80 to $100 range, all the way up to 200 and some. And again, I sold there too. Maybe it keeps running, maybe it doesn't. Did you already go over Netflix? I had to take a phone call. No, we can go over Netflix right now. I really like Netflix. One thing. I was going to build out Netflix into a 7% position in my portfolio right here. I was going to build it out to a 7% position. But then they pulled out of the Warner Brothers deal. And I'm up already like, I don't even know. What am I up? I'm already up like 20 some percent on my Netflix position. I really like Netflix, but I'm going to only build a 5% position now. One, because it's already getting close to fair value for me, but I'm okay holding this at fair value and like letting it run because it's such a moat company. It's such a great company. I think there'll be a $1 trillion market cap one day, currently at 417 billion. I really would have liked them to have that acquisition, but I get they didn't want to just spend crazy amounts, or spend whatever amount that Warner Brothers was demanding. Warner Brothers had a ton of debt that Netflix would have had to take on, but the biggest thing is like Game of Thrones, Harry Potter, DC, Superman, Batman, like all those great brands. Like they could have just done so many shows for kids and adults and movies and so many things with those brands. But it's okay. It's okay. You know, you can't have it all, right? So finally getting recognition. Yeah, probably. Jeez. It's crazy. Oh, this is what I posted, by the way. I said I thought Oscar was going to $8. Clown face. Because Oscar to go to $8, guys. I'm gonna pull up on Netflix, buddy. Just give me a second. I'm gonna pull it up on Value Snapshot. For Oscar to go to $8, like it'd be insane. It would be insane. Why would it be insane? Because when you actually look at Oscar, guys, check this out. They are. Oh, here's a market cap on this. I need to put the market cap on here. Oscar's a $3.85 billion market cap. Let me see. Yeah, they're 1471 today. So right around $4 billion market cap. Okay. They were around like $3 billion market cap not too long ago. They just guided for 18 to 19 billion dollars in revenue. They just had their highest membership growth and highest membership number ever. around a $4 billion market cap. Again, I'm H-Dog. I'm going to get to Netflix. Just give me a second. Guys, around 4 billion. Okay. Okay. For them to get to $8, they would have to be a sub like $2.53 billion market cap. Well, you tell me, how would it make sense for them to be a sub $2.53 billion market cap when they have a net cash position of $2.3 billion? So they're going to be a $2.5 billion market cap company and have $2.3 billion in cash. So if they liquidated everything, you would get your money back. But also, they do 700 and some million in million in free cash flow. So they just did 1.1 billion in free cash flow. And they have 2.3 billion dollars in debt. And they're going to do 1.1 billion in free cash flow. So that's like 3.4 billion. And the market cap's like 3.8 billion right now. But it was going to go to $8. Do you see how the math isn't mathing? And they have uh 3 billion? No. 3 million. They have 3 million. Oh my God, if they had 3 billion, that'd be insane. 3.4, I believe it was 3.4 million. Let's pull it up. Earnings transcripts. Oh man. You see how the math isn't mathing though, friends? Do you see? Crazy. So, oh yeah, their SG&A costs are continuing to come down. It's literally been because of medical loss ratios that they're losing any kind of money, and they're guiding for a profitable 2026. Let's see. Yep, serve 3.4 million members, but they do expect that to drop to 3 million paid members by the Q2. Still a 58% increase year over year. But yeah, let's take it down to $2.5 billion market cap with $2.3 billion in net cash over debt and $1.1 billion in free cash flow and guide for $18 to $19 billion in revenue and have a profitable year. Yeah. If they got bought out, a company wouldn't pay them below or at their liquidity value, dummy. Oh gosh. Okay. Netflix. People hurt my brain. Oscar there for a minute, and it's pretty much still, I think, is like an arbitrage play. Okay. Netflix. Netflix was just in the video I just did yesterday of 5 stocks I'm buying this month. So I really like Netflix, but again, I don't love the fact that they've already jumped so much. Again, they've jumped a lot already. They went from $75 all the way up to $98. So they've already jumped a lot. I was buying in the 70s and 80s and 90s, and now they're almost back over $100. So I don't love that. And I don't get Warner Brothers anymore. But here's what I think. Let's see. Give them a 40 terminal. I think they can grow to 22% free cash flow margin, 13% revenue growth. So I think fair value today is $120. So I'm still building my position. I'll finish building that 5% position once we get a bull trigger, which we are getting very close. We're getting very close to that bull trigger, friends. Very, very close. Very close to that bull trigger here. And just so you know, just so you know, they've only come out of here a few times. 2022, they got down to these levels. You can see that? 2022, they've got down to these levels about -90. And then they went on a historic run out of the bear market, up and away. And then in October 2023, same thing. They got not as far though and went on a historic run. And if you chop sideways up here, that's okay. Like you can continue going up. You're just gonna have pullbacks. But look at the bull trigger here, right here. This was after the bear market, and they went on this historic run. Look at this. These are basically the same drawdowns. Huge drawdowns, well below the 21 EMA, well below, like basically bouncing off the 200-week moving average, and now moving higher, reclaiming the 21 EMA on the weekly. And again, they're about to print this bull trigger for the second time at being that oversold. They can go on another huge run, guys, another huge run. So yeah, I really like Netflix. I think it's undervalued, about 21% undervalued. Consensus is 117. So I'm right around consensus of analysts. The high for analysts is 152. So EPS. EPS $108 is fair value in my book, 18% EPS growth rate, a PE of 30 after 5 years, which you can easily have 35 in there if you wanted to. And then right around the same thing, 125. This is a very, very good moat. It's a great moat, honestly. Great company. Look at the financials, guys. They're just gonna go quarter in, quarter out, year in, year out, margins up and to the right, just every single year. Revenues up and to the right, net margins, net income up and to the right, operating gross up and to the right, EBITDA up and to the right, cash flows up and to the right, CapEx not too bad, keeping it in line. Cash to debt, assets to debt, 55 billion, almost double assets to liabilities. Debt's a little higher than cash, but remember they're making movies and shows and all this stuff. They're always going to have high debt. Shares have come down about 100 million. EPS exploding. Debt to equity ratio coming down. Love to see it. Free cash flow per share, $2.24. Crushing it. Highest it's ever been. Return on assets, almost 20%. Return on equity, almost 41%. Oh. Ad sales revenue for 2026 guiding for $3 billion. Let's see. Operating profit growth 30%. Let's see. Addressable market share for consumer and ad spend about 7%. They only have 7% of the addressable market. They only have 7% of the overall TAM for consumer and ad spend. So you think they can't grow a lot? Yeah, they can. Revenue forecast of 51 billion, revenue growth of 14% projected for 2026. Content authorization, amortization growth roughly 10%. Engagement viewing per members per day, so 2 times per day. Audience size nearly 1 billion. Paid households 300 million. TV hour shares 10. Consumer spend and ad revenue share 6. These are all like nice little KPIs. and AI insights from forward guidance, operational KPIs that you can come down here and see in the financials tool and valuesnapshot.io as well. Yeah, looking really good. Looking really good. Like I said, we just ran the valuations. So, can you do Shopify or Service now? Yo, Ronnie, open a half position in App 11 this morning before market open. Definitely don't regret it. Let's go. Yeah, App 11, I think, is up. App 11 was another stock that I said I was buying for 2020, or sorry, buying this month as well. You see, I got a double top on there. It definitely could come down here, but I think you need the markets to really, really have some bad times ahead. And it could have already bottomed. This is just a measured move. It doesn't always happen. It would be pretty crazy to get down there on this company with how much they're growing and crushing it, honestly. BZAI is up 11%. Yeah, they're down the dumps though. All right, let's see. Monthly chart. So I was looking at Shopify yesterday because I was like, I really like Shopify. Do I want to buy Shopify? And I was running projections, and it's just an expensive stock. It's always been an expensive stock. I think it always is going to be an expensive stock. But they're growing 20% consistently. They have been. Um, and they're just growing so well. So well. Let's see. Gross margins of 54% down to 48%. I don't love that. Margins are going down there. Take out gross margins. Take out these net margins. Okay, operating and free cash flow margins are climbing. That's good. Net margins came down in 2025. Don't love that. Their revenue's exploding, guys. Exploding. But year over year, they did less net income. They're down 39% net income year over year. Gross and operating are doing well. EBITDA is climbing. Operating and free cash flows are climbing. CapEx is down. Balance sheet's amazing. Holy crap. 15 billion in assets and only about 2 billion in liabilities. That's insane. 1.5 billion in cash, 188 million in debt. Wow. But they're spending up their cash. Their cash is going down. Shares are going up. They're on track to oh no, they've petered out the last few years. So that's good. EPS is down year over year. Debt to equity is like nothing. Free cash flow per share is 155, really good. That's what I don't like. The net margins and stuff are, I don't know. Love to hear it, Clayton. Love to hear it. Appreciate that, man. Thanks for the validation, brother. So what do we see with Shopify? A lot of our margins are actually coming down for 2025 from 2024. Return on equity, return on assets are coming down year over year. EPS is down, net income is down, while revenues are all up. Don't love that. And you can see what happened to the stock, right? The stock has just, said, nah. It's had a massive pullback. It pulled all the way down to 105. It's already rebounded a ton. But here are their earnings that they missed. Yeah, in 2025, they missed missed half their earnings. And the matrix was telling us in 2023 there's a great buying opportunity with this bull trigger and coming out of this flush out, and then we could have went up and away and held this thing from 55 up to 181. Hey, just some words of appreciation. I've been searching for YouTubers who cover Zeta as I'm very bullish in it and came across your channel. Thanks for your work and content about Zeta. I appreciated that. I appreciate it, man. Appreciate it. Yeah, it's funny. It's funny you found me because not to toot my own horn, but I've been a Zeta bull for a while. A while. I'm one of the OGs. I'm one of the OGs in the Zeta community, and finding this stock and talking a lot about it. Again, not to toot my own horn. I don't want to sound like a douche, but yeah, I'm just so bullish on the company. I'm so happy that so many other people are coming across this stock now and understanding the bull case around it and how big of an opportunity is. Because at the end of the day, guys, what do we know? At the end of the day, guys, it's all about retail making a ton of money. Like, it doesn't really matter who set a stock first. It doesn't matter who put out the first article. None of it matters. What really matters is us, all of us together. We all beat Wall Street. We beat the head honchos and we crush the markets together. That's what it's all about. We are retail. I am retail. You are retail. We are all the retail community. And why would we be at each other's throats or trying to one up each other instead of coming together and trying to beat Wall Street? Like we've done with Tesla, like we've done with Palantir, SoFi, Robinhood, IREN, Nebius, so many stocks, so many stocks. It's all about coming together and beating Wall Street, guys. That's what it's about. That's what it's about. So if I can highlight a stock that I like and I found, and somebody else can do that. Like I've never been first on a stock ever. Nobody's ever been first on a stock ever. It's impossible. There's too many people out there to be first on a stock ever. What really matters is just putting out good due diligence, helping people understand your bull thesis, helping people understand a company that they might not understand, and saying, hey, I think this is a great opportunity. And then it's up to you to do your own research. You can do that with Value Snapshot. You can do that with whatever. But I knew if you were in here, you were gonna say that, you idiot. Um, proof. Show me proof, Wealth. So yeah, he knocked me off my look. He's such a D1 hater. But yeah, so that's all that matters, guys. That's all that matters. All that matters is we all make money and provide for our families and do it in a way that is honorable, honestly. So yeah, Shopify. We would have been buying down here, would have been doing really, really well. But we might have a reset now. We might have a reset where Shopify comes back down here into the sweet spot. You get it down here in like the 80s again or something like that. And it'll probably be a really, really good opportunity there. Because when I run the projections here, not saying we're going to 20x from here, but I believe in a 4 to 5x in the next couple of years. For Zeta, I mean, yeah, I mean, if you watch the beginning of this live stream, I actually went in depth into Zeta's financials. I went in depth with my like ultra bull case and my bear to base case and everything, and I talked about like where I see the stock going. But yeah, I mean, look, if they get to 10 billion revenue, basically because of their like them expanding their wallet share, they legit could 10x. They legit could. I know I've just been accumulating slowly over time because I had a feeling until it really really became a real thing. One started looking for YouTubers. I feel we have a Palantir kind of moment ahead. I do too. I do too. What is your favorite SaaS to buy during this dip? Zeta. Remember, Zeta is a SaaS company. Zeta. Number two would probably be Netflix. Netflix is a subscription as a service. So I think Netflix is a really, really just great moat and great company. Um, Besides that, like I think Adobe's cheap. It's just hard pinpointing when that thing's going to turn around and when Wall Street's going to say, yeah, that's too cheap. Maybe now with Burry buying. I don't know. If we see Shopify down around 80 again, that is a steal of a buy, and I will be buying the dip. Yeah. What do you think about Path? I like Path. It's not one of my highest conviction companies. Um, I like my biggest bear case about Path is just that they need to prove that Claude and other AI and other companies and big tech companies can't just replicate what they have. So yeah. All right. Yeah, Shopify analysts have a low of 115, consensus of 165, and high of 200. I ran analysis here, and at today's prices, it's overvalued. Again, based on current trailing 12-month revenues, growing at 22% for the next 5 years, getting to 22% free cash flow margins. Again, they're not even at that right now. They're at about 18%. Right now, trailing 12-month, they're at 17%. Like I said, they've gone down. So based on that, and with a conservative 30 times free cash flow multiple at the end of 5 years, which I think is fair. You see right now they have an 83. If they had an 83 in 5 years' time, then this thing's undervalued and it's a massive buy. But are they going to have an 83 in 10 years' time? Or sorry, 5 years' time? I don't believe so. It's gone from 135 down to 83, and I think it'll go down again. So let's just say it goes like 45. If it goes to 45, then yeah, it's still undervalued. If it goes to 40, then yeah, it's slightly undervalued. When I buy a company, I want to be buying off conservative assumptions, not outlandish assumptions. So if I sit in here and I say they're going to grow 22% over the next 5 years, and analysts agree with me, 27, 23, 26, 15, 19, that's an average about 22. 22. 22% revenue growth, free cash flow margins getting to 22% average over 5 years, even though they're going down right now. You know, I'm being more not being so conservative there, so I have to be conservative somewhere. It's either I sit here and I go 40 and then I say, okay, I think let's just say they get to 18 and then it's not fair value. If we look, how about we look at EPS, right? Because that's just one model, DCF. 94 cents of EPS. They're set to grow about, let's call it 30%. Well, I have 0% here. Let's call it about 27%. 27% over the next 5 years of EPS. Their PE multiple should not be 136. Let's go more conservative. Again, I can't say it's not. Let's go with 50. Even with a 50, it's still overpriced. So even a 30% EPS growth rate with a 50 multiple, yeah, it's tough. It's tough. So yeah, let's go with 143 instead. Again, even though their trailing 12-month was point whatever, let's go with the 27%. Again, slightly undervalued. Again, maybe if it was back down, here at 106, then I would be a buyer of this. But now it has already rebounded, and running into the 21 EMA, it could reject. And so I'm not loving and sitting here saying like, yeah, I really want to buy here. You know what I mean? Look at Oscar up 9% today. Amazing. Yeah, a lot of stuff is just up and away today. Overall markets are doing really, really good. Crypto's flying. Crypto's flying. I wonder when crypto bottoms. That's going to be crazy. Crazy times when crypto bottoms finally. All right. What else we got? Now, when I look at Path too, like it's undervalued. Again, the only thing that's in my brain, I don't want to build into too big of a position. I was going to buy Shop at under $5 in 2019. Oh gosh, it's rough, man. Happens. It happens to all of us. I was gonna buy Robinhood under $20 and I didn't. So now I'm buying Robinhood at like 100 and some dollars, or like no 80 some dollars. It is what it is, man. We can't always, get the best places. On a yearly basis, gross margins are climbing, free cash flow, gross margins are climbing, right? Yep. 71 to 83, 0% free cash flows to 21. Net margins and operating margins negative 173 to 176 to only negative 5 and 11%. So they're trying to climb, having their inflection point, trying to get to net profitable. Their free cash flow looks really good. Their EBIT is still climbing. Their free cash flow is really what you would base this off of. Is really what you're valuing Path off of, is their free cash flow. Tons of assets, 2.9, almost 3 times the amount of liabilities. 880 million of cash, 0 debt. I don't know why the cash is coming down so hastily from 1.8. They lost over 1 billion in cash. And they haven't been spending that much. UiPath is better to have massive annual recurring revenue reacceleration. Yeah. Better than what? Shopify? Right now, based on valuations, I would take Path over Shopify. Shares outstanding, staying in line. I like that. They've actually came down year over year. Free cash flow per share, 55 cents. That's climbing. Return on assets, return on equity. They're about to flip those. Yeah, I read what you were saying. So if we look at Path, right? If we look at UiPath, almost a $6 billion market cap, pulling 1.55 billion in revenue, 230 million in net income. Average revenue growth over the last 3 years, 17%, 20% free cash flow, 3.82 price to sales. Current PE is 26. Analyst price targets are a low of 14, a consensus of 16, and a high of 19. Well under 26%, 47%, 71% upside from current price to $11.10. Valuation. Last valuation I ran was December 30th. And we are well below that. So based on this DCF, with conservative assumptions of only 15% revenue growth for the next 5 years, and like Nick was saying, they could accelerate to 20% plus revenue growth. So at 15% and current margins of 20% on free cash flow, which is what they're doing trailing 12 month, it keeps climbing higher. And at a conservative 25 terminal value, let's just say you want to do what they're currently at, even though they've been massively sold off and their average is 26. Let's go with a conservative 20. We have a stock that is underpriced. Currently $11.10. Intrinsic value is $18. 61% upside. If they reaccelerate their revenues to, let's say, what do analysts say? Worse is officially the next Fed. Really? Sweet. See, I think analysts are way off here. They're expecting low teens to high single digit growth. Let's say you did 10%, 20, and 20. They're still undervalued. So even if you go based off analysts, you still have upward trajectory to like $15, $19 over 5 years. But again, I think they could re-accelerate here to say like 25%. Their 5 years 35, their 3 years 17, and their 1 year is 9. So let's just say 20. They re-accelerate to 20%. Free cash flow gets to 21%, and then you give them what they've actually been priced at. You have 157% upside right now. Intrinsic value is $28, and 5 years time, $40. So about a 4x in 5 years time would be great returns. Again, this isn't financial advice. We're just kind of, throwing numbers out there and projections, trying to see like the bull case, mid case, bear case, right? Yeah, most of the analysts didn't even show up to UiPath call last time, and they didn't even hear the commentary that they gave about acceleration and massive demand. Let's check that acceleration and massive demand. Let's go to their earnings call. Earnings call summary. Earnings transcript for last quarter in December. It's funny, dude. All right. Annual recurring revenue of 1.782 billion, up 11% year over year, beating the high end. Revenue reached 411 million, 16% increase. GAAP profitability reported its first GAAP profitable third quarter. Phenomenal. Non-GAAP of 88 million. FYI, massive demand note was from CNBC interview at Dines. Okay. Yeah, I think I watched that one. Full year outlook on track to be GAAP profitable for the full year 2026. Love to see that. Here's some strategic initiatives. Agent tech AI and orchestration, continued focus on combining the deterministic automation with intelligent and adaptable agents, evidenced by over 950 companies developing agents and more than 365,000 processes orchestrated by Maestro. That's huge. Product enhancement. Launched UiPath screenplay for more reliable UI automation. Enhanced agent builder for faster pilot to production, and introduce agent TI capabilities to intelligent extraction and processing product. Strategic partnerships. Announced new integrations with Microsoft Azure AI Foundry, OpenAI ChatGPT connector, Google Gemini models, NVIDIA NIM microservices, and Snowflake Cortex AI expanding platform capabilities. Love it. Vertical solutions and cloud expansion, introduce industry-specific solutions leveraging the Peak acquisition and expanded automation cloud footprint to Switzerland and UAE. Notable management quotes. Our automation strategy, combining the reliability of deterministic automation with the intelligence and adaptability of agent Tiki, continues to align with what consumers want most: trusted in enterprises grade automation that delivers tangible return on investment fast, says Daniel Dines. The momentum we are seeing in the market isn't just in our results. It is how our customers and partners are engaging with UiPath. Customers tell us they get the most impact from our unified platform, bringing together deterministic automation, agentic intelligence, and process orchestration. Risk and challenges. The call primarily focused on positive performance and future opportunities, with no specific risks or challenges highlighted in the provided transcript snippet. Management indicated a dynamic federal purchasing environment, but noted pockets of strength. Let's see. continued growth in annual recurring revenue, ARR progress, and customer adoption of Agent Tiki, AI, and Maestro, and expansion of strategic partnerships. Okay. Sounds like a very, very strong and good earnings. Valuation. Did we already do the valuation? I think we did. EPS. Let's take non-GAAP of 53 cents. Let's say they grow 15% and have a 26, and yeah, they're undervalued. So every way you look at it, they're pretty undervalued, and the consensus is pretty spot on. So yeah, looks good. Company looks good. The charts don't look good, obviously. It's a falling knife. If we look at a monthly chart, the great thing about the monthly chart, guys, is it is at its like lowest point. It's at where it's seen support over and over and over again. Support, 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 support. So this like $9.50 to like $12 range, it has very, very strong support. And based on valuations, guys, from here, up to 17, 50%, 100% up to 22, and if you hit the high end, you're looking at 150%. So it definitely can break down lower. Definitely can. But overall, they've been beating earnings year over year. 11 cent. No, hold on. 20 cents guided. They did 26 cents. Now they're guiding for 26 cents, and they'll probably beat that. 425 million, and they missed. Now guiding for 465 million. So things are continuing to get better for this company. Looks good. Looks good. All right, guys. It's almost 2 hours. So I'm going to go ahead and wrap it up there. Zeta's up 2.5% today, sticking above that 18 bucks. Oscar's almost above $15 per share. That is so massive from where we were just a few weeks ago, all the way down at like sub 12 bucks. And people were saying it's going to go to 8. Mobilize up a little bit today. Still not looking great on the monthly chart. Path is at support. It's undervalued in my opinion. Pagaya is at support. It's undervalued in my position. And a lot of other companies are looking very, very good here. Just waiting for things to flip and have a bull trigger. The overall markets, as I've been posting about to my subscribers on X and in the trading community and investing community, overall markets don't look the greatest still. There's still room to fall down here. There's still room to fall down here. There's still room to get down to the sweet spot here. So overall, just be careful out there. There's been green days, there's been red days, there's been big ups, there's been big downs. In these times, you just need to have a plan. You need to have structure, and that is what we are doing over here at Value Snapshot. We are giving a proper strategy, talking about when we're buying, how we're building out positions, a 1-2 approach essentially. We have all the tools to run valuation models. We have everything you need. You can see my portfolio, all the moves that I'm making. You can see my article write-ups on the companies and why I'm bullish on them. You can see exclusive videos, live streams like this. We also have an inner circle that is way more one-on-one. It's also way more expensive. But for all of this, besides the inner circle, it's a 7-day free trial right now, and it's actually only $8 a month. I made it so cheap so that I literally can just pay for the data for the site, because I built all this for me and to make my investing life easier and my trading life too, because I use it for that as well. I made it all to make my life 10 times easier. And now I'm sharing it with everybody. That way we can all be on one team in the retail community, come together and crush it here in the chats, here in all this content, and using these amazing tools to make life easier for investing. Earning summaries, valuations, projections, seeing the financial data, seeing the charts, seeing with visuals, where is this company going? Are they growing EPS? Are they declining on margins? So on and so forth. So again, if you want access to this, you can come on over here to valuesnapshot.io, 7-day free trial right now. You get access to all of this for free for 7 days. You can also run projections up to 5 times completely free without any credit card. There's my pitch. If you want any of this stuff, guys, come on over. Join us on valuesnapshot.io. If not, completely fine. I appreciate your support. Smash the like button, subscribe for more, and I will catch you guys later. Take it easy.